We want to talk about what's going on with the economy, especially when it comes to, we talk a lot about interest rates, but there have been headlines today regarding interest rates that a lot of us as investors need to be able to put into plain English and not the monetary wonky talk that we hear so often from the Fed. To help us make heads or tails of what's coming at us economically, we invite into the stream Ellen Gaske, PGIM fixed income lead economist. It's good to have you here. Thank you for joining us.
It's great to be here. Thank you.
So I want to start with the headlines which broke today, and I'm going to start with, Federal Reserve Governor Chris Waller, who indicated that we know tapering is going to speed up. We got that at the last FOMC meeting, but that liftoff, the beginning of raising interest rates, could be as soon as March. Market trying to digest that. As an economist, how should we consider what he has now shared with us?
Yes. So the Fed at its meeting this week surprised, I think, moderately on the hawkish side. But by and large, markets were ready for what they unveiled. They certainly had already well telegraphed that they wanted to speed up the pace of tapering. Markets, I think, digested that well. Markets have been talking about the need to begin tapering as early as, I would say, last July. So that part was not a surprise. The markets had already priced in almost 3 rate hikes for next year, and the Fed followed through that without its median projection, penciling in fact, 3 rate hikes for next year. But critically, what they were doing at the meeting by speeding up tapering, they are opening up the optionality for next year to be able to hike rates as needed, depending on how conditions unfold. So already we've seen a wholesale shift in their focus away from the unemployment mandate to this elevated inflation, persistent inflation pressures we're seeing. Notably, all of them seemed on board this week to begin rate liftoff. And it's not surprising to see some thinking maybe as soon as March. The high inflation clearly has Fed officials nervous.
Okay, so high inflation has them nervous today, and I don't know right now because I don't have my computer running to show it, but the yield curve was flattening between the 2 and the 10. That would normally be a cause of concern for some people that a recession could be coming. But then I want to read a quote, because this morning John Williams was on television and he said that monetary policy over the past quarter century or even longer has shown we can accomplish and deliver stable, low inflation and try to mitigate the effects of recessions, and we can get the economy back to maximum employment. What he was saying essentially is, even if we start to raise interest rates, we won't throw this economy into recession. What do you think?
Yes, well, I'm in agreement. I don't see the yield curve where it is now as signaling negative signs about the economy going forward. It's in line with where we think that 10-year Treasury rate should be right at this moment, at about 1.4%. We think that it already has priced in about the kind of rate hikes that we're expecting over the next couple of years. We're expecting the Fed to hike base case 2 times, but certainly they could hike more than that next year, followed by another, say, 3 or several more in 2023. But critically, we think the Fed is going to likely get stopped out in its rate hikes in the 1.5% to 2% range. We saw last cycle that when the Fed exceeded 2%, there were visible signs that they were going too far. Economic interest-sensitive sectors of the economy were beginning to slow. And indeed, when the Fed hit 2.5%, it had to quickly reverse course, make a U-turn, and began quickly cutting rates back again. We think this time the Fed's not likely to make that same mistake, that they'll get topped out in the 1.5% to 2% range. And I think the 10-year is appropriately priced, reflecting that. All of that's against a positive backdrop, an expected positive outlook for growth going forward. It does assume that inflation will moderate back towards 2%. So it's a positive outlook, but just one with a much less hawkish Fed over the long term than we saw before.
So if we've got, what is it, 9 trillion on the Fed balance sheet, and part of this inflation is, the incredible expansion of liquidity into the money supply. Should investors be worried if that starts to slow down, or is it going to be many lifetimes past ours that 9 trillion truly shrinks?
So that's emerged as a key question on people's minds. What happens after the taper? In thinking about it, Powell did reveal that they had a robust discussion about the balance sheet and are likely to continue to have that discussion for at least several more meetings. So I think no decision on shrinking the balance sheet is imminent. But when thinking about it, I think it makes a lot of sense for the Fed to follow the same playbook they followed last cycle. In other words, get a significant number of rate hikes under their belts and then think about shrinking the balance sheet. One thing, they understand a bit better the impact of rate hikes on slowing aggregate demand. Balance sheet shrinkage, that's a little less certain and depends so much on the rest of market conditions. So it's a bit, I think, risky to think about turning two tightening knobs at the same time. I think they'll wait. I think rolling off the balance sheet is maybe a 2023 event, not next year.
We appreciate your insight and sharing it with us. Helen Gaske, PGIM, fixed income lead economist. All the best. You have a good weekend and a happy holiday.